Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee free transactions. Whether it's gaming, AI, or next gen dApps, Scale is here to power your future. Explore more at scale.space/ecosystem and follow them on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. GlobalStake is redefining staking with performance, security, and sustainability at its core. GlobalStake's self-owned, end-to-end bare metal infrastructure gives you unparalleled performance and risk management. Plus, with SOC 2 Type 2 and CCSS certifications, you get institutional grade protection you can count on. And it doesn't stop there. GlobalStake is carbon negative, meaning the more you stake, the better it is for the planet. With global reach, competitive pricing, and slashing insurance backed by the highest rated carriers, it's time to upgrade your staking game. Join the future of staking with GlobalStake, your trusted partner in institutional staking. Visit globalstake.io to experience its white glove service, superior economics, and best-in-class security. Hey everyone, so we recorded this roundup yesterday, and I felt like it was really important to be able to still have an analysis and a snapshot into what happened with the jobs report that happened this morning. So what I thought I would do is just do a little, 10-minute preamble where we discuss the recent print, and then we can look into how that reflects things and see from there how we're thinking about the markets from then on. So I'm just going to go through a few of the different data points and then my initial take on it, and then we'll go from there. So right off the bat here, I'm just going to pull up the data points, but we got the jobs report this morning and it came in very hot by all measures. So non-farm payrolls itself came in at 256,000 versus the consensus 160,000 jobs. So way above expectations. And not only that, and this is the one that really surprised me as well, is that the unemployment rate actually downticked. So we saw it come in at 4.1% versus the consensus of 4.2%, and that's been a decrease since the previous month. One other really notable point here is you just look at the bottom, non-farm private payrolls, very, very, very strong. That came in at 223,000 versus the consensus 135. So by all accounts, if you look at all data points, this is a blockbuster jobs report. And as always, with any of my analysis of the labor market, I really lean on the Burning Glass Institute's charts and analysis here. I think they do a really fantastic job of just really understanding and distilling and visualizing the data. So this is a really great chart here that just shows the unemployment rate path compared to the current FOMC summary economic projections. So their forecast of the unemployment rate. And what we can see is we downtick significantly. So currently their forecast for 2025 is to basically go to 4.3% and sit flat there. And we've actually seen a downward tick lower, like I mentioned, to 4.1%. So what does this mean is that the labor market is even stronger than what was expected in the dot plots just a month ago. So obviously a lot of talk happens around revisions related to the jobs report and the non-farm payrolls. So just wanted to dig into that. So in October, we saw revisions increase from 36,000 to 43,000. And then for November, we saw them actually get a downward revision by 15,000. So from 227,000 to 212. So that gives you a net lower revision of 8,000 jobs. Now, this is the thing, and I've said this a few times, but the revisions are quite linear. They're not really convex. So it's quite easy to linearly extrapolate what you would assume is the revision. So this is what this chart does here, where Guy Berger just basically bakes in the assumed revision into the non-farm payroll. And that's what that strong line is compared to the dotted line. So what we can see is that if you look at the dotted line and you bake in these revisions, it's still obviously, you can see that there's been a rebound higher despite these revisions. You can just bake it in from the get-go effectively. Part-time for economic reasons. This is a really interesting one for just seeing, there's been a lot of this talk about, if somebody's losing their job, they don't want to go, file for initial jobless claims or anything. They can go get a part-time job for economic reasons like DoorDash or Uber. And so to see this reverse lower is also quite notable that there's some strength forming in the labor market. Now, this is the money one for really understanding what are the dynamics that are being affected by the strength or weakness in terms of layoffs and that dynamic. This is the key one. So this chart just breaks it apart, and we can look at the most important one is the black line, so permanent layoffs. This is the one where if we were seeing signs of an early recession or something like that, we would see this skyrocketing. So last month, we saw this tick up higher, but we've seen a full reversal of that, which is very notable. At the same time that we're actually seeing job leavers, so people voluntarily quitting their jobs, has actually ticked up higher, which is really interesting. So, if there's confidence to leave your job and that you have the confidence that you can go get another job in fairly short order, that's also another positive sign for the labor market. So that's the jobs report at a high level, but there's obviously different, more high frequency data points that we can look at as well. So I just wanted to discuss as well the initial claims point here. So this comes out every week. We had this recent point come out just the last couple of days. And what's really interesting here is we've just seen a full reversal of this uptick in initial claims data. If you look at the 4-week moving average, which smooths out a lot of this noise, you can see we're in a down move. So this data is seasonally adjusted. So there is that. But effectively what we're seeing here is that the labor market is reaccelerating. And then another key point here is also just around jobs openings. So we got the JOLTS report earlier this week as well. So that gives a pretty good insight into seeing what is the availability of the jobs market right now. And we've been in a pretty steady decline in job openings for the past 2 years. And this was a lot of the premise behind why the Fed felt like they could achieve a soft landing, is that they could try to lower inflation while there's this buffer of a lot of job openings, so that as people lost their jobs, there was this buffer where there was still a ton of jobs open that they could file into. So we saw this decrease and basically bottom out in September. And we've actually seen a pretty significant rebound higher in job openings, which is also quite telling. So there's a lot of, what I feel like was pent up decisions from corporations to hire that they wanted to wait until we saw resolution from the election. We had Danny Dane that joined the Roundup a few weeks ago, and this has been a lot of his thesis, so props to him on that one. But effectively what we're seeing is a lot of validation of this right now. So where does that leave us? It leaves us in a world with what looks like a very solid jobs report, even compared to expectations from a month ago from the Fed. So we need to start to think about how that gets reflected against their dual mandate of inflation as well. What we're seeing is starting to tick up higher, be sticky, whatever you want to call it. But the fact is, when we get these data points that come in like this, that are providing a lot of strength for the labor market, at the same time that we're starting to see some on the margin inflation concerns, that shifts the focus of the Fed. So start to get reflected in markets and pricing for the cutting cycle right now. And effectively what we're seeing now is that the market is saying the cutting cycle is done. And this is what's really interesting, is that Bank of America has said, yes, it's done, but also we think there's risks for a potential hike. So this is pretty much the first time I've seen any talk about a reversal towards talking about hikes. And this is very notable. If we're starting to shift towards a world where we're thinking about hikes again in the next year or so, that can have some pretty interesting impacts on risk assets. So effectively, going into this, there's about 1 to 2 cuts priced for 2025. This chart here at the bottom is just showing the March meeting, and you can see that yesterday we were at about 40% odds of a cut in March, and now we're down substantially to about 30%. So it's highly likely that we're going to see a pause now in March. January is already baked in as a pause. There was no real change there. It's been pretty baked in. Maybe if we saw a really weak jobs report, we could see talk about a cut in January, but that's clearly off the table now. So as we navigate this, we have to start to shift our thinking a little bit towards, okay, the Fed is prioritizing, it has to prioritize inflation once again. there's no real reason for them to try to ease based on labor market data like we were seeing in August and September. It was quite weak, and that gave them a lot of validation to cut significantly. This is basically the complete opposite now. So it's going to shape 2025. And again, this is being reflected. We've seen bond yields surge higher over the last day or so, and you start to have to think about, okay, this is labor market data from the past couple months, but we're seeing some tightening of financial conditions right now. We're seeing bond yields rise across the spectrum. How does that get reflected in the growth narrative 6 to 8 months from now? And so, generally speaking, as we see these increases in bond yields, one might think that could have a slowing effect on the economy. If you just use the simple analog of mortgage rates and the housing market, higher mortgage rates, that's putting a pressure on basically income and just the ability to afford housing prices, et cetera. So this was by all means a very strong report and definitely shifts the narrative for 2025 to be more towards hawkishness and tightening compared to the dovish inclinations that we've had for the past 6 months. So I hope that helps. The rest of the roundup is still very, very useful and prescient. We sort of had this mindset of there's a lot of hawkishness priced in, but it could still occur. So still a very useful episode and a ton in there to dig in. So, don't just jump on now. Definitely stay and commit for that one because it's a great episode. All right. Thanks, everybody. All right. Welcome back. Happy New Year. Roundup edition. Forward guidance. We got the trio back in 2025. Man, it's been a few weeks. I have been itching to get back to chatting with you guys. How's your New Year? What's going on, guys?
Happy New Year. I'm tired. It's been at home with the kids for 2 weeks, chasing them around. Good Lord. You think it's a vacation? It's not a vacation.
It's a vacation for Quinn and I.
Yeah. You guys were skiing and having fun. I mean, Dad. That's all I heard.
No, it's good. It's good. It's good to be back, though. Missed you guys. The Fridays are, I guess Thursday today, but highlight of my week. It's always fun to talk shop.
Really is. I feel like I've had so many fragmented thoughts that, normally we get this hour every week to just kind of digest and distill things. And I just feel like my brain has been scattered. So I'm excited to get back in the swing of things with you guys. Charlie, you got a cool new background. You got a Bloomberg showing off there now.
Yeah,
look at that thing.
That's called Bloomberg. Yeah, a lot of good prices out
there. A lot of good prices. A lot of good data points to get lost in.
I gotta get it. It's a great product. I don't. Everyone's forced to use it because it's so damn good. But it's like $30,000 a year or something insane.
Yeah,
it's tough to stomach, but
yeah.
It's got a lot of useful stuff.
You can get your charts for free.
Yeah, let me tell you about TradingView.
Yeah. TradingView's pretty good for free service.
It's true.
Yeah.
It's true. Okay, before we get into the swing of things, got to do a little shill fest here. Digital Asset Summit happening in March in New York. The three of us going to be there. A lot of great guests that are regularly on Forward Guidance are also going to be there. Joseph Wang. We have Mohammed Al-Arian, who's going to be one of the keynote speakers. And just announced today.
I am Mohammed Al-Arian. I love the Jets. Sorry.
And now he's about to cancel.
I like him. He's a good guy.
No, me too. He's awesome.
Just has a funny
but
affect.
He's no second best to the one and only Michael Saylor of MicroStrategy, who was just announced that he will be speaking at it as well. So come on by, meet us, meet Michael, hear him talk, hear about the digital Bitcoin hornet's nest or whatever he calls it. But yeah, get your tickets. It's gonna be a ton of fun. We're all gonna be there, so don't miss it.
Big land. That's awesome.
Yeah,
huge land. Very, props to the events team. I just get to show off, but they've been grinding.
He's a huge fan of Forward Guidance, I heard.
He should be for how much we don't always hype it up. Sometimes we say to sell everything because it's trading at a 3x premium, and that's fucking ridiculous. So nuanced takes, as always.
We're balanced.
Yeah.
Fair and balanced. Fox News.
Yeah. So I want to spend this episode just talking about our approach to 2025. It's been a few weeks since we've caught up. It feels like a lot has changed, but also not a lot has changed. We obviously had that pretty hawkish FOMC meeting that took a lot of people by surprise. I mean, just look at the impact on the VIX during those days, just to see how offside everybody was compared to what actually occurred. And that sort of contextualized a lot of market dynamics since. I know I've had a lot of time to think about how I'm approaching this year. I know, you both have. And so I think what we could do is just, I think a few of us have just some different ideas or themes to talk a bit about and that are going to dominate 2025. And we can go through a few of them. And obviously, we can start from the top line here. And the first one I want to bring up is this idea of whether we see an economic slowdown or not in 2025. I would say about a month ago, this was very non-consensus as an idea of this potential growth slowdown that could occur in Q1 this year. It feels like it's starting to become a lot more consensus. We haven't necessarily seen that much economic data roll over per se, but if you just look at like the surprise index, economic surprise index, that part has been rolling over, but not the absolute data points. So it's still in this transition phase away from what I would characterize as from August until November or something of just constant upside surprises. Now we're starting to see some downside surprises. So for me, that's my framework. I guess, I'll call myself consensus, but to me, I view this, you look at what's going on. We'll talk about this a bit more in terms of what's been going on with the long bond yields and that, but there's these factors that really are starting to affect the economy. Mortgage rates are just getting decimated while inventories increase in the housing market. And I think that's going to be another major influence on the growth story for 2025. So I'm roughly in the camp of slowdown, at least for the beginning. But I also think that people are getting a bit over their skis in terms of front running that. I feel like it's a bit too soon as well. So I'm curious how both of you guys are thinking about that.
Yeah, I have a slide on page, I think it's slide 35, just showing the ISM manufacturing, US manufacturing, non-manufacturing indices, which are kind of turning up a little bit. They bottomed, I guess, in 2023-ish and started to peak back. Obviously, the labor market's been deteriorating fundamentally for a while. That's not really anything new, and it's what really kicked off the growth scare in the summer. But, I think people are getting over their skis quite a bit because while we're not going to be growing at the 2023 levels, real GDP is still expected to be, in the mid twos, and you have inflation, which add on top to the real GDP. You're still getting a nominal, pretty elevated growth level. And so, I think there's a lot of pro-business, pro-regulatory, pro-growth aspects of a Trump administration. And it feels like we are getting to a point of peak Trump fear-mongering again, which tends to happen in these recurring cycles. The media has their way with, kind of only emphasizing the good or the bad that he brings, which there's a lot of noise. There's a lot of, there's a lot of headlines, but it's also part of his strategy and tactics. And if you remember 2017, the same thing was going on into 2017, how it was going to be the most tumultuous presidential. And then the stock market had like a maximum of like a couple % dip all throughout the year. So I think there's a lot of things at play, and people have a right to be a bit more, just have a skeptical lens. We've kind of been talking about that for a while now. The liquidity setup has not been great, but is it the time to be getting, max growth scare bearish after we've had such, kind of fairly large moves in yields and everything? I think there's going to need to be some time for it to feed through if it does. And I think until proven otherwise, you probably want to fade that because one, the fiscal deficits are going to continue. Like they're going to cut things, but they're also going to try and reduce taxes. So those offset. And, it's overall still fairly healthy. So, and the Fed still has room to cut, right? We know they think they're in a restrictive stance, and we know that QT is likely to end this year. So there's still tools in the tool shed that are likely to be used to bolster growth, bolster liquidity. So these macro things take a long time to play out. And I maybe am seeing people in the investor universe latch onto one of my core tendencies, which is most macro tendencies, which is to be way too early. You feel like you can see the end goal.
That's the
crystal
classic
clear.
issue for macro people, is that we're too early and it takes longer. And to your point, I'll just quickly show this chart from Andrew Santa Larson, talk about what you mentioned, which is that last time too, we saw the Dixie rise quite a bit. And then basically as Trump took office, it was just basically a downward move there. So this has been my framework personally. It's just like that we would see the top in the Dixie Neals. I've already been wrong and kind of thinking that we're at the top, and then we keep topping higher. So who knows? Curious what you think, Tyler.
Yeah. I mean, this is where I am not going to lie. As I said, this next couple of weeks or months period is really the cloudiest period. So protect yourselves. Overall, I still think it's a bull market. I haven't seen any companies report really dire earnings yet. When that starts happening and you really see it flow through earnings, I'll probably change my tune. The biggest problem in the market is on the sovereign and geopolitical side. And that is what, it's the global margin call on US denominated debt outside of the US. That's really what's going on right now. And I can go through a couple charts just to go through it. I mean, hit me with slide 22. And this is just to give you a sense, like a lot of countries, they issue US denominated debt. And as the dollar rises, they have to pay back that debt in more expensive dollars. So, low income countries use, US bond markets to essentially raise their debt. You can see here, this is low income countries' external debt payments. And as that goes up, and then if you go to slide 23, this is the US dollar trade weighted dollar, which is basically at all-time highs. So this is causing like a giant global liquidity crisis for collateral in dollars. And, that's why we're seeing funky stuff happening in FX markets. This is what's funny to me is it's largely a policy decision. So if you go to the next slide is the 2-10s curve. They allowed the yield curve to essentially steepen. For 2022 and 2023, Yellen was issuing paper on the front end of the yield curve, and the duration problem on the longer end bonds was not an issue. And now they're actually letting, you could say it's the debt ceiling, you could say it's all these other things, but the yield curve is steepening now, which is causing kind of a constriction in liquidity, and the term premium is rising. So if you go to the next slide, you can see this is from Mike Howell, great chart. The black line is the net supply of duration, so the amount of longer term bonds coming to market. And then as that rises, the term premium rises, which is the orange line. So that's why we're seeing the steepening of the yield curve. And then, what's tricky to me, if you go to slide 27, and this is all to say, this is why the dollar has gotten way stronger. And we've talked about this. This is the Asian dollar index on 3 different time frames. The first one, you can see the RSI, it is at 28. It's so oversold. So it's like we're basically going full on into like a US dollar crisis right now, which can be solved because corporates are doing fine. Generally speaking, this is all geopolitics and global policy. So, and I call them vol controllers. And the vol controllers could stop this with swap lines. They could stop this, with saying they're easing. But we're gonna see what decision they make here, which is really annoying because they might actually let things, roll off too, just to be fair. But the Asian dollar currency is getting absolutely annihilated. If you look at the yen, the yuan, the Korean won, the dong, which is Quinn's favorite, these are all weakening to such extremes. The next slide is the yuan, Chinese yuan. If you go out, this is basically, they have to ease. And as they ease, this is globally deflationary or disinflationary. As the yuan goes higher to the dollar, that means, there's more yuan to dollars. That means the dollar goes stronger. And when that happens, Luke Groman had a great podcast on this. He's like, There's 13 trillion in emerging market debt in the US. As that dollar goes higher, it causes them to have to sell, the $68 trillion worth of equities to basically pay off that debt. So it creates this global sucking of liquidity. They sell equities to essentially, and then they sell the debt, and all the reserves kind of shrink. And that's sort of the environment we're in, which is basically because we don't have enough dollars floating around the system. Now that could also be, and then go to slide 30. This is just to give you a sense. This is also, we talk about this, before the break, but the Chinese 2-year yields, basically China's in massive deflation, and they're in a balance sheet recession. And as these things, we need China to actually loosen up their monetary policy as well, but that could cause the dollar to even spike further. So it's kind of this self-reinforcing global liquidity suck is what we're in right now, even in the face of all that. What's tricky for me, and this is, I'm getting to my last point, and this is where I'm mind-bogglingly like, if you look at all these things happening geopolitically, FX wise, you would expect high yield bonds in the US to be blowing out and financing costs to be like outrageous. But if you go to slide 31, this is the CDX on high yield. I mean, it's up a little bit from the lows, but it's still really like, it's still very good financing for the crappiest companies in the market. So, to Quinn's point, like growth slowdown, I don't see it on the corporate side. Like, I think everyone's just going off of, the interest rate spike and fast forwarding and expecting everyone's going to miss earnings. But like corporates have financed themselves okay. Like their balance sheets are way healthier. This is a sovereign problem, which could flow through to if you get this global liquidity suck, you got to watch this chart specifically, because if this spikes, that means sovereign investors are repatriating capital and bringing it back home to pay off their debts.
Tyler, I feel like the point you made at the beginning about how it feels like we're in this weird gray danger zone for the next little bit here. It feels like that a lot of that is caused from the stalemate that you just described in terms of like global FX and global yields right now, where China can't stimulate right now because the dollar's too strong versus the yuan. The dollar's too strong right now because there's a lot of potential talk right now from Trump tariff policy, et cetera, and what that could do. And it feels like none of this can be potentially resolved until at least the inauguration, where, there's a good chance that, Xi Jinping and Trump come to some sort of currency agreement, like that has been something that they've talked about, at least on the Trump side, that they want a lower dollar and they're willing to do currency devaluations. China would love that. It would allow them to stimulate and get out of this deflationary spiral that they're in right now. So it feels like there's a lot of these stalemates right now that are just hard to rectify for at least the short term.
Yeah, and I think that's the main issue is like you look out 2 to 3 months, almost everyone's probably like, yeah, the dollar's going to be lower, because like if it's not, we're all in a shitstorm. Like if it's not, boomers are going to have a hard time paying their pensions. Like what's so crazy to me is like boomers' bond portfolios get absolutely torched. And my rule of thumb is the boomer Ponzi scheme will find any way to bail out the boomers. That's just the end result with diluted dollars. So you look out, 3 to 6 months, the dollar has to be lower, because if it's not, then like the system doesn't work. Is sort of my general sense.
The one thing that's been tricky is the price action in a lot of days the last few weeks has just screamed like the end of fiat, where the market, risk assets, I would say people are getting very bearish now. I mean, stocks are off like 5%ish, 4 to 5. Bitcoin's off like 10 to 13 or something off highs. So, it feels like we're getting to a point, at least locally, where there's more of the negatives getting priced in. Maybe it's not enough. Maybe we got to go lower. But, a lot of these trades, it's like you don't want to own bonds. And the other thing is you look at gold, which has been so sturdy despite this real rate rise. I mean, frankly, Bitcoin and stocks have been sturdy too, because it's sort of like the market saying, we see the dollar zooming up, but it's kind of a sovereign problem. It's not a corporate or earnings problem. So
And it's not a
we
dollar
know how
liquidity
this
problem
ends.
yet. Yeah.
Yeah, it's like we know how this ends, and I think there's some reasons to think we are reaching a local peak in yields. Like the Fed still, people are conflating the long bond with the front end, right? And I think the Fed still does have room to cut, and they're going to end QT, and we know the yield curve has to steepen to a more normalized level. I have some charts on this actually.
While you find that, I just want to quickly say on that point of like global bond yields, like to your point, this has not been like if you look at inflation swaps, which is something like Tyler brings up often in the show, those have been flat as yields have been going higher. And like a lot of these countries are in pretty like shitty economic growth situations right now. So to see the bond yields surge like this, despite that, it tells you it's something else going on right now. So it tells you, like you said, it's the sovereign, long bond issuance debt load problem. Really, it's less so the inflation situation.
Check slide 32 if you can. This is where it's 32. Yeah, there we go. Okay.
Is this the gilt?
This is the gilt, the 10-year on the gilt. And this is the worst combination you could possibly have. This is the UK basically turning into a third world country. So you have the 10-year yield on the gilt is shockingly going up. And then if you go to the next one, the pound is weakening. It's like money is getting the F out of the UK. And where do you go? Like you probably go to gold. And this is one of the world premier like global centers for financial capital markets. And they've completely messed up everything there. And that in itself is really scary when you think about it.
I mean, we're seeing like the dollar milkshake theory in action right now.
Yeah, exactly. And that's, well, what happens when, if China has this giant, trade imbalance. We buy their stuff, they get dollars, they usually reinvest it in buying treasuries. What if they stop doing that and just start buying gold instead? It's like, that's the end game here, where maybe then we all turn into giant money printing machines and debt doesn't mean anything. And you have to decide on a different, sovereign collateral. That could be the world. Like things are changing that fast. I don't think people are realizing it, but like that could be the world where you have to decide as a country, am I going to plug into the Allied system and buy, US debt? Am I going to plug into, the Asian financial system and use gold as collateral? Like we're kind of getting there. And otherwise, but I think with Trump at the helm, you get this global peace dividend, you get some negotiating, the dollar goes lower, we get some disinflationary effects and the game goes on. But like, there's also an alternate reality where things get really ugly and get out of control. So that's why I say watch the credit spreads. But right now it's sovereigns. It's sovereigns and FX that are just really concerned.
Quinn, what charts were you talking about there? You wanted to?
It's slide 38. And then 37. 38 is the yield curve, the 3 month, the 10-year minus 3 month. You can see how inverted it was negatively, which was historically very abnormal. And that's why you saw small banks and small businesses being hurt so bad, is because the long end was being suppressed by the Treasury and Fed's, coordination, Yellen's front end issuance, and that was allowing them to keep the front end abnormally high. And now we're seeing that reverse, right? Where I would call this like normalization of interest rate policy, where the back end should be higher and the front end should be lower, which is why I kind of believe like at the end of the day, there are more rate cuts coming, whether they're necessarily good or bad, if they're too late, and there's already the problems underway, the inertia of the economy is real. It remains to be seen. But there is liquidity tools available. The Fed believes they're restrictive. If you go to the slide before 37, we can see basically rate cut expectations for the FOMC, 75% chance of only one or less cut by end of June, and 50% chance of one or less cut by year end, which I just think is too low. I mean, even in a healthy economy, policy is on the front end restrictive. The long end is becoming also restrictive. So I think that will need to be continued to be balanced out. But these things don't mean that a certain stock or a certain asset is a good buy or not. There's other dynamics at play, but I do think there's, I just caution getting like extremely bearish too early, because I think there are levers to be pulled here.
Yeah, I think to the same vein, not getting too bullish either. Like this is, I do want to emphasize, like the reason I've been sort of short-term concerned / bearish or whatever you want to call it has been because we're finally getting this third, trifecta or whatever of tightening that's finally occurring. So we've had the hike of the Fed funds, the short rate that's been going on for a while, and that's done some slowing to different parts of the economy. But this has been something like Andy Costa has talked about a lot over the last couple of years, that we haven't seen that final tightening push because the long end has just been basically too low to do any sort of marginal tightening. And so now it feels like, okay, we got the short rate high plus this tilt towards hawkishness since December from the FOMC. At the same time that we're seeing long bond yields globally rise substantially, at the same time that we're seeing the US dollar surge and do its dollar wrecking ball thing, those three together, they're an expression right now of what looks like almost like too much economic strength / inflation. But the weird thing is that, I don't know, 6 months down the road from now, those are actually going to be the contributors that actually lead to this marginal slowing, not saying recession or anything. It's whether that slowdown is more than what's expected right now by some people or, less than what's expected. But the fact is that that's occurring. So when that occurs, and we can get into this too, I know, is around just like positioning dynamics and equity valuations, is when you have those factors start to be reflected against the tension of positioning, that's where you start to get these pockets and risk. And so personally, that's why, I believe that we're seeing, Bitcoin struggle here, and we're seeing equities, vol is increasing. We haven't fully broken down or anything, but there's been a lot of volatility to the upside and then to the downside. That looks like, it's been compressing somewhat, but the vol is about to expand. We're going to get the resolution better for worse. That's how I think about it.
What do you guys think? I've noticed every single morning when Europe opens, crypto takes an absolute digger. To me, that's a sign that like something's messed up in Europe too. And I think people are trying to just like get the hell out, because the European, I guess, governance system right now is so anti-capital. And I think that might be who's really keeping a cap on this stuff. But you'd think with a strategic Bitcoin reserve from the US government on the headlines in the next couple months, potentially, there would be more of a premium baked in for some scenario like that. And it just seems like there's odd forces at play here, especially when you see the DOJ selling $6 billion on the day where the market's closed. I'm like, come on.
Yeah, classic.
It's just a classic kick in the junk. Like, and everyone's like, this is always, this is how they operate. It's completely non-political. And like, how do you even remotely say that at this point? It's like,
you can't.
You're doing something that is a complete antithesis of what's best for your citizens. And having, if your government's saying they might do a strategic Bitcoin reserve, the incoming president has talked about it, and you're gonna sell that before. Like, come on, that's worse for your city. You don't care about your citizens.
I mean, and it's funny, $6 billion is like, I mean, that doesn't even register on the Pentagon's like any of these government agencies.
They print that overnight, but like at the same time, it's
here's an exercise. What to you guys? Okay, so we have the 2 10-year at a positive 43 basis points, the highest since February 22. All right, or March 22, February 22, and we have the 10-year. What do we have the 10-year at 4.7, the 30-year at 4.9. What, like, what needs to happen for these to keep rising, if anything? Like, because I'm looking here, and I mean, we're talking about these are the reasons I was cautious and bearish a few weeks ago. But now they're peaking out. I mean, like, or maybe they're not. But like,
I'm just going to use this chart here to set up.
Keeps this going.
Scale is shaking up the blockchain game. With a gas-free and visible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at scale.space/ecosystem and follow their journey on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. GlobalStake is redefining staking with performance, security, and sustainability at its core. GlobalStake's self-owned, end-to-end bare metal infrastructure gives you unparalleled performance and risk management. Plus, with SOC 2 Type 2 and CCSS certifications, you get institutional grade protection you can count on. And it doesn't stop there. GlobalStake is carbon negative, meaning the more you stake, the better it is for the planet. With global reach, competitive pricing, and slashing insurance backed by the highest rated carriers, it's time to upgrade your staking game. Join the future of staking with GlobalStake, your trusted partner in institutional staking. Visit globalstake.io to experience its white glove service, superior economics, and best-in-class security. Yeah, I'm just going to pull this chart up from our buddy Capital Flows, who's been doing this wicked composition in Excel. But it just shows, this is super helpful for contextualizing what we're talking about. It's the 210s curve, and then it's basically color-coded by what sort of like steepener/flattener that's been occurring. So you can see, like, in the summer, the green part, so from August to late September, that was all bull steepener. So that was recession fears. That was the twos. That was the shorter end of the curve coming down relative to the long end. We have the exact opposite situation right now. So even though the curve is steepening, it's due to the bear steepener, not a. So we've seen the long end go higher compared to the short rates, like the twos. So that's a completely different.
Somebody look at this as a complete political setup, but.
I mean, we should get into this about the minutes too from the FOMC, but it's quite interesting. But yeah, so remind me about your question again, Quinn, on this, on the 210s.
My question is, like, as everyone is getting very, bearish on bonds, hawkish on yields here, what are people's targets? Because my targets have kind of been hit in the near term on the long bond yields. And personally, like, I think we're starting to get the reaction, from people that they're too tight. And so my inclination is like, okay, well, that's going to start pressing on growth if they are too tight, and kind of put a meter on how high they actually would go. So I'm curious if people are very, very, bullish dollar, hawkish yields here. Like, what is the continuation of that?
Yeah, so I mean, I felt like 2 weeks ago was going to be the peak, and I was wrong, and it feels like a lot of that is because of the amount of uncertainty right now between today and the inauguration. So, in my opinion, you look at like the 5% threshold for the long end, like the 10s or something. When we've gone to that point, things have occurred that are not quite official, but you look back and you're like, okay, that was around the time when Janet Yellen was doing trips to China, and these sort of ideas start to happen around these levels. So we're getting, the 10s is getting really close to that 5% threshold where stuff starts to happen. And then you look at like term premium on the 10-year, we've broken out of like the last peak that was, I don't know, a year ago or something like that, where that was when equities were starting to get pressed by bond yields. So we're around that level right now. And it feels like a lot of the reasoning for it is baked into this idea of, again, uncertainty around Trump policy and inauguration, et cetera. So yeah, I don't see what would bring us much higher other than perhaps like just a panic / lack of faith in bond yields and just like a panic sell. And that's where, you might start to see potential for a temporary QE type operation like we saw in Bank of England a couple of years ago with like the gilt crisis, where they came in for 2 weeks and did QE and then reversed it 6 months later or whatever. I think that's the potential, but yeah, it feels like to me this is it or very close to it. So I don't know what would bring us higher.
Here's my thing is this reminds me so much of the pre-election in 2016 fear mongering, like as if we didn't have 4 years. And I hate to get on this, like I'm off the political train, and the train worked and I was right, but I don't want to get back on it, but it seems like the same exact thing. I mean, we had 4 years of Trump. He oversaw disinflation. We saw his tariff policy in action. He renegotiated NAFTA. He used the tariffs to get better trade deals, and he used them as the carrot and stick approach. And he never once, completely blanketed, full industries that mattered to CPI. And so I'm kind of sitting here and it's like, we're on the doorstep of his inauguration. Right now, everything's just talk and people are scared, and I just feel the bearishness elevating. And granted, the thing that gives me the most caution is the fact that there hasn't been a big release on risk assets yet. And normally you feel much more comfortable stepping in after that release occurs. So maybe that happens soon. But my point is just that, like, let's remember who's coming in his treasury. Besant, one of the most successful hedge fund managers of all time in the macro world. We have Moran, we have, Kevin Warsh, who's a top pick for potential Fed or whatever. Like, these people, like, their goal is not to like say, oh, Yellen left us a big shit show, we're just gonna let it all rinse to the floor. And their goal is to keep stability. And I just think, like, these are the best brains in the world you want. And what it is, it's a managed control of policy shift and adjustment where the back end has to go higher, the front end has to come down. And it really has to, because of how much centralization and control the vol controllers that Tyler mentions have had, to get out of it, you'd still need that. So, like, we talk a lot of, about Yellen and how much she's juiced these markets, and there's definitely politics there. And it's probably going to, like, here's I'll offer the other side. The people who don't like the incoming administration are going to say the same thing, because they're going to say, well, Besant and Powell are working together to maneuver the yield curve steeper while bringing front end rates down, while not causing a recession and keeping risk assets elevated. That's going to be the thing. And it's going to be true because they have to. Otherwise, they would oversee a crash. And
it's a Ponzi.
Yeah. So, like, I just can't. I was pretty cautious, pretty bearish. I'm not like getting crazy bullish or anything. There's not like this big catalyst like I was pounding the table on in November. But I just think that these things take way longer to play out, and it does feel, whether it's now, maybe it's in a week, maybe it's in 2 weeks, we are seeing the hysteria levels rise. I mean, for example, the long bond yield, if you just think about it like this, the implied volatility in the long bond has moved up dramatically. Like VIX TLT basically is near the highs. And that's usually a sign, right, of like max uncertainty.
I just start for that.
I don't know what's like, I guess I like if the economy isn't blowing out, inflation is still kind of like meandering along. I just don't know what like is so uncertain right now. Why that implied vol isn't going to come down. Like, I feel very good. Trump and Besant are not going to like cause a COVID style inflationary like burst with tariffs.
You want to know this is my call for tomorrow morning. This is the jobs number tomorrow morning. This is just off positioning. So just take it for what it is. But right now, everyone is long the dollar. Everyone is short yields. Everyone is long VIX. The VIX is almost inverted. If you get a jobs number that is worse than expected, all those things are going to reverse, which basically means Fed expectations for easing goes up. the dollar goes lower, yields go lower, and the market takes off higher. That's that's where the positioning is most extreme. And then this is a great chart on, let's see, what is this, slide 26. This is, to your point on TLT. Quinn said TLT's vol spiked. So you see, this is the different look. This is shares outstanding of TLT, which is kind of fascinating. And so it went all the way to new highs was that November, and then just had this massive drawdown. And then when you have the massive drawdown, shares outstanding starts going away because people are selling, right? Selling their TLT. And then it based off of the 250-day, it's RSI. And this is probably a chart crime because we're looking at shares outstanding and not price. But to your point, like, it's kind of based. And if you look at the vol dynamics, the vol blew out on the low, and now investors are not positioned for that. So like,
this
just
is
from a positioning, short-term positioning standpoint, you'd almost imagine that the market would unwind those things, and then maybe you get some Trump commentary on a weak dollar, et cetera, and then things, the narrative changes.
Yeah, Tyler, your point about it being a chart crime, I think it's so useful. Look at that. Even throughout 2022, right? Shares outstanding.
That's exactly what I was going to say. Yeah,
rising, and never once dipping like that. Despite yields straight vertical up. Like
the last time RSI was there was in, was it January of 2022, and from there it went on a giant ripper.
This looks like capitulation of the long bond incessant flow in, because to your point, throughout 2022, inflows kept hammering in because they're like, oh, return to ZERP. And now finally we're seeing this reversal. This is a really great chart.
Yeah.
Which doesn't mean
let's also
need to go straight down, but yeah, exactly. No, it's like we're at a local fever pitch where everyone was like screaming top bloody murder recession like 4 months ago. It's like crypto Twitter, like screaming all-time highs 3 days ago, and then we dropped 10%. Everyone said the cycle's over. It's just hilarious, this ebb and flow. We're getting these moves in like days that normally take weeks.
I really want to talk about this just from a social perspective too. This looks like this is the same chart as like XHB. Like if you look at home builders or anything tied to housing, if this goes lower, housing it's like 30% of our economy just takes an absolute shit.
Bad things happen.
And here's a fascinating thing. This is what I talk. You take the chart down. This is existential.
Let's go 1 to 1.
One of my buddies he's like 5 years younger than me, and he's like, dude, I'm working my balls off. I make 250 grand a year, and he's like, I do pretty damn well. I can't in my right mind buy a house in like a nice suburb where interest rates are. Like, that's insanity. He's like, I'm paying, if I at the end where the 30-year mortgage is right now, making 250 grand, I'm paying it was like something like 12 grand a month with 20% down on that house. He's like, the math doesn't math. He's 35, he just had his first kid. And like that, the math doesn't math for the next generation unless interest rates are lower. Does that make sense? Like, this is more just generationally. You're making 250 grand and you can't afford a house in a nice neighborhood. Like, and maybe that's an egregious thing to say, but like, if you do the math for like $1 million house at a mortgage, a 30-year mortgage at 3% is way different than $1 million house at a mortgage at 7-8%.
Well, here's just a less like, it's a more objective data point, not even pining on his affordability. My condo, to rent it, the cost I'm paying, if I were to purchase it with a new mortgage, just assume like 10 or 20, whatever, 30% down, and just the average mortgage rate plus HOA plus insurance plus tax, my monthly payment would be 2x what I pay for rent. And I hope my landlord isn't listening to this. But like, that's clinically insane. Like, how could you even think about, I mean, why would you, it's just like, like you said, the math doesn't math. I wouldn't.
You wouldn't buy, why you, and then take on top, okay, fire insurance. Like, think about California fire insurance going up, costs cost of labor.
There's not going to be any insurance.
If you didn't get a mortgage when it was low, it makes zero sense to buy a house. And then one of my buddies, Kellen Grenier, good watches the show, good buddy. He's like, this is an asset that keeps up inflation, but then you have costs, your costs, your taxes go up every year on it anyway too. So it's a horrible store of value. So
well, it's an extension of bonds.
Yeah,
because you're tied to the local government. You have to pay whatever they tax you, just like inflation is taxing bondholders. You're getting taxed. It's hilarious. But the reason to buy it would be because your dollars are worthless. So you're like, well, shit, it's got.
That's what I'm saying.
Well, I mean, talking for Canada here, where our entire economy is fucking built up on this shit. Like it becomes part of the social contract of the government to support it.
Exactly.
And if you fail that social contract, like bad things happen to society. Birth rates crater like they are.
Yeah. So
people don't partner up and marry. Yeah.
You have to dilute the currency or no one has kids.
Exactly.
It's the bottom line. There's no pass through of the assets. The assets have to be sold to the next generation, or they just create like this haves and have nots, like people that own assets and then just rent them to you because they locked in a fucking interest rate really low. Like, I mean, I got insanely lucky buying my house when I had 3% interest rates. And then I'm like, and anyone who's buying in with interest rates up here is just a moron. Like my house shouldn't be like a sticker value of the house is just not what it is.
The price has to come down because the rates probably won't.
Yes, but like I don't think the government would actually do that, because what does that mean for pension? What does that mean for pensioners or for the commercial real estate market or all these fucking? That's why it's such a fucking Ponzi. It's so ridiculous that even though we know the dollar might come down, there'll be like, we know in 3 to 5 years that dollar is going to be worth nothing and diluted, and we're going to print the hell out of it. And like, that's the end game no matter what. But like, I don't know. I figured housing is great to talk about because it really is for your guys' generation.
It's the zeitgeist, yeah.
Getting married, they're having children, they're doing the math, and the math doesn't math.
I think I have a good catalyst for, and yeah, I love how Raoul Pal has been so early to this notion, and he's taken a lot of heat from traditional macro people, but in reality, I think I'm seeing more and more come around to the death of fiat notion. Like, it was a very taboo thing to be saying, literally buy Bitcoin because the dollar is worthless. But like, you're now seeing like Cuppies, welcome to Africa, or Zimbabwe, Project Zimbabwe memes. Every macro person is now coming onto it. It's just not every macro person is changing their investment style to adjust, right? So I have we didn't really come up with a catalyst for why bond yields should continue rising from here. I think panic, fear, and just the fact that the yield curve should ultimately be steeper. But I think we're at sort of a localish top here or so. I have a catalyst why it might be relieved, which is, one, the higher they go, the more downward pressure it puts on growth, and therefore the lower, like, it puts a cap on them. But the second is, there's still some left in the RRP, which needs to get drained. That should be drained, right? They should use that. Investment should use it. And two, the budget, there's been a lot of fear and anxiety about the debt ceiling and burden, but what would actually be the most logical thing to do if you're Bessent and Trump would be to drain the TGA to zero, extend the debt ceiling and budget negotiations as long as humanly possible to get whatever you want passed and done. Meanwhile, you're relieving, you're not issuing debt, you're draining the TGA. That by definition takes duration out of the market. By there's no new issuance, and you're taking it out of the Treasury's bank account at the Fed. And that takes a very large seller out of the market, the issuer. So I think that's what you do here. And you provide some liquidity reprieve. You see the next month or two of inflation and labor. I think the underpinnings of this recent labor market data has been not that strong. Like the same small business weakening trends are continuing. And I think the Fed, maybe they don't cut in March, but maybe they cut April. Maybe they start guiding towards like April, August, December or something, and you get to a little bit more of a normal path. That's, they shouldn't cut 100 basis points in 3 or 4 months like they did in the fall. That was they should have started July 25, and then they wouldn't need as many cuts. So, we just tend to move towards these extremes of growth, boom, recession, and it's like just trying to like stay balanced and not too bear hold and not too bull hold, because it's a very choppy environment.
That's why I like the 2-year trade so much, because to your point, the long bond yield is what's going to slow the economy, but we don't know really how much higher it goes. We know fundamentally this is about as high as it should go, but again, things can get emotional. But the fact is that whatever does there it'll pass the baton to the 2-year note, which is basically at equal to Fed funds right now. So it's saying unless we started to talk about hikes, your downside is pretty much capped. You can lever that up on the 2-year and run with that, and that is just basically your upside convexity on any further cuts than what's priced right now. And that's sort of like neutral to any sort of market bias.
Yeah, the hawk to a trade.
The hawk to a trade, yeah.
the ETF, Tyler, is TUA. I sent this trade to a couple buddies. Like it is being like one of my favorite plays right now. Just longing the 2-year. And every single person I sent it to just replies, ha ha, hawk to a. And I was like, wow, you're so original. Like, it's just like, that's our society. Everything's a meme. Everything's a meme.
Yeah.
Okay, I want to ask you guys, like everything we talked about, it feels like it's coming around this point of tension and inflection of the inauguration. So I want to hear, do you guys see that? Originally I was thinking that we would run up, Bitcoin for a while into the inauguration up only, and it could be potentially like a short-term sell the news. It almost feels like a buy the news situation now. Do you guys agree with that?
Yeah, I'm like, if you just zoom out here and look at the biggest drawdowns that Bitcoin, and I'm kind of just talking about Bitcoin because, I mean, even alts have corrected massively. Like I stopped looking at alt charts like 3 weeks ago when I turned cautious, and I just pulled them up and ran through them today. I was like, oh wow, some of these are actually looking interesting. When I was told I'm an idiot for not being balls long every single altcoin, and now they're all minus 40. But I think, yeah, Bitcoin's max drawdown last year was 27%, I think, from peak to trough. And that took 6 months with many, many bounces in between. And it took a recession scare and a no Fed liquidity at all. So I'm kind of like, we're down like 10 to 14% from all-time highs. Like, I really don't think like the world's falling apart like this quickly. I think there's a very capable, treasury and team coming in. And like at the end of the day, there's sort of a Trump put, like in a sense, like it seemed like over the last few weeks, every time Bitcoin dipped, like a Trump family member was out and about talking about it. And if you're just like game theory, I know everybody's talking about the strategic Bitcoin reserve, which I'm personally sort of a fader of, like in terms of its impact on the market. Like, cool narrative, sweet, awesome. But like, are they going to just start gobbling up Bitcoin? Probably not. But if we're having this conversation and, there's no way we're the only people in the world seeing the end game here for financial markets, which is fiat, the death of fiat. If you're a central bank, like you're China, you're Japan, you're trying to protect your currency right now. What are you doing? You're selling your treasuries. You're selling your dollars. You're selling your other assets. And you have to buy something that's going to hold value. And, traditionally that's gold and oil. But I really think like, there's going to be more sovereigns that do adopt this. And to me, that's just just not a reason to get super bearish at range lows going into what I think could be a big catalyst.
It hasn't broken from the breakout point. Like 90K would really be something where you'd be concerned something's changed in the market. Like, is there disinflation, deflation impulses? But yeah, I mean, this has just been in a channel the whole time.
Exactly.
2 months. It's tough to get, over. One guy I wanted to mention before we go is David Zervos has been pretty spot on and consistent about the market for the past like 10 years, really. And he understands the innards of the Fed. He worked there. He's Jefferies' chief market strategist, and his new theme is basically buy risk parity, which is stocks and bonds will both rise here. Spoos and Blues, he calls it. And I think he might have even said like it's going to be just a great year for equities in general. But what he also said is he's using the acronym LFG, less funding for the government, I believe, and basically saying that should keep, the government, if you look at the past 10 years, has crowded out the private market in a lot of senses with the amount of treasuries they've issued and the funding. They've crowded out from the private bond markets. And if you do cut spending in some of these egregious things, like I saw some, the head of water and park in LA was making $750,000 a year, and which is just insane. Like, there's just egregious spending everywhere you look. And Tucker Carlson had this great line too. He was like, I looked around in my neighborhood in Washington, D.C., and I realized it was beautiful, multi-million-dollar houses, and nobody in the neighborhood actually produced anything. They didn't produce anything. And it's so when you think about it, like for a generation, we've really been pillaged by the public sector, and not like, I'm not. I mean, I'm a believer in the public sector. Like I think there needs to be. I'm not like this hardcore right winger by any means, but I do think there's egregious things that have been spent on that. If you annihilate that, maybe treasury yields come smashing back down. Is sort of what I'm saying. It's like, some of the pork that's in these bills has just gotten so insane. Like, we're handing money over to Ukraine at insane amounts. And I don't know. The whole thing's.
That's an interesting idea, because I've been a pretty big fader of the Doge thing in terms of like the actual dollar value of deficit they can decrease. But that is a bit more interesting around what would that occur in terms of psychological impact and like potential impact on yields too. It's like, okay, like, Elon said today, like 2 trillion is not going to happen. And it just takes 10 seconds to look at like what's congressionally mandated in terms of spending in Congress and Treasury. But just the fact that they're going and doing this could have a larger impact on things like bond yields. That's a really interesting idea.
Could you imagine if you have an investigative reporter that's like, hi, you make $750,000 as a public employee. What do you do on a daily basis? Or like, what do you like? If you had people that just went out and like shone a light on it, because largely the centralized media has actually been an accomplice to like this whole thing, and now you have decentralized media. I'm sure there's going to be this pendulum's going to swing, and you're going to have the spotlight on you if you're doing nefarious stuff.
Well, let me just walk through the mechanics here for listeners on why this is good. I hear people saying, oh, well, it's bearish if Doge occurs and the deficits fall, and it's bearish for risk assets. No, that's actually unbelievable. It's the same way you invest in a company when they cut useless costs and their earnings rise, because what happens is all the billions of dollars to Ukraine, all the billions of dollars to wars in the Middle East, the deficits are only bullish when they're being financed and printed money to support, right? If we spend $1 trillion of excess and have to finance that into the open market and splash that on the market, and you have to find all these duration buyers who otherwise would be investing in other productive assets, that's bearish. But then that's not happening because the RRP and the Fed is monetizing the debt and printing dollars out of one pocket to fund the other pocket. But what happens if, okay, so we've been sending tens of billions of dollars to the Middle East and Ukraine, Russia. We're literally that's not printing dollars. That's spending dollars that need to be financed to create more geopolitical, risk in the market. There's a twofold bad for the market. We're literally increasing the price of oil by prolonging the geopolitical conflict. We're creating uncertainty and volatility in the market by funding these wars, and it's coming out of our pocket. Like that meme of like somehow our tax dollars, somehow also our tax dollars of the Iranian and Israeli missiles. That's real. And so if you remove all the spending, or the person who sits in their house and gets paid $500K to work from home and oversee like random useless things, that's just money back. And then those people have to go get real jobs, be real productive citizens, not leeches on the system. They're actually building things that the economy needs, and the government is spending less and everybody's better off. So like there are really bullish outcomes. It's a matter of like how co-opted by the swamp do these people get? Like, can Elon actually get it done?
I agree. I think like to a certain extent, I don't want to completely knock government spending. There's a lot of great things that have come out. It's just you need to have that government spending go to productive means. I think it just got in this last like 10 years have just gotten so egregious with like, if you look at the money supply just up and to the right where they started handing money out for anything. And it's got to go back to like this chat GPT moment to basically like, how do you take a bill that's like, whatever gazillion pages and distill it so that you know what's in it? Like people don't even know what it's in anymore. So like, I think that's massively productivity enhancing in itself. And maybe our generations get back to the point where it's like, let's do things that are productive instead of just like spraying and praying.
Yeah. The one nuance I want to add and push back on a little bit is just around the deficit and whether it's stimulative or like money printing or not. I think to your point, you hinted at there is it depends on how that duration is getting issued. Like if it's bills like it's been, I would say it's outright printing and stimulative. But if it's, longer duration in terms of how that gets financed, I think you're correct that it could be a good thing. So if we're assuming that we're moving back from this heavy dominance of bills towards coupons, then I think your point is correct.
Mm-hmm. Yeah, it's interesting, man. Like the amount of at a time where it feels like maybe it's not always, maybe it's always been this case where things are this centrally controlled and this manipulated, but it's
maybe it's always been.
Yeah, but it's definitely a first in terms of the universal access to information, public knowledge, social media, and understanding of these topics, and that's is pretty interesting because you're seeing it's the decentralization of everything. The best ideas are now not at big bank research; they're in Twitter threads and Substacks and seeking alphas. Like this, just you're seeing it everywhere, and it's just super fascinating to see how it's going to play out. Because back in the day, you probably had J.P. Morgan and and the bankers controlling the world in a room of 4 people making decisions. Now it's kind of out in the open, and like we're just going to increase transparency, which overall is good. The truth sets you free.
Yeah, you just got to get the ability to go viral. The hard,
yeah.
On the left, you could say like, oh yeah, but then you got like Elon Musk and all this centralizing, the largest, he's got Trump's here. There is a concern with that, which I totally get too, to be fair. But
well, guys, let's leave it at that. Good to hash things out. This was overdue. It's going to be a fun year.
Sure,
yeah,
we'll
maybe this will be the year that crypto natives stop basing every assumption of the market they have on one 2021 cycle that came with very insane abnormal macro conditions, and we can finally kill the 4-year cycle notion and just accept that no asset in the world trades on preordained 4-year cycles. Gold.
Every altcoin doesn't all go up in unison. There's such thing as dispersion. So yes, we can rant, but we missed out. We were going to talk about that, about just talking shit about the 4-year cycle. We'll do it next week, but I agree.
Awesome, boys. Good chat. Fun to be back.
Yeah. Looking for a blockchain that combines high performance with zero headaches? Scale is your answer. With its advanced parallel processing and modular sharding, Scale delivers gas-free transactions and limitless scalability, perfect for gaming, AI, and consumer-facing dApps. Already a top 10 blockchain on dApp radar, Scale is powering next-gen use cases with over 750 million transactions and counting. Discover the future of Web3 at scale.space/ecosystem and stay up to date with their journey on X at Scale Network.